While you're having your breakfast, I see all of you back, so we'll slowly get started. Before I do today's core financial insight, which is on stock market investing, something came up during the break. I want you to know that we have started, as you can see, Dave is recording this, and these sessions have been recorded right from the get-go in 2009 when we started them, and this is the 13th session. So what we've done is we've taken these recorded sessions, edited them, and we've put them on a YouTube channel. Okay, it's called youtube.com/the GPS process, and you'll find this there. Even today's one, we'll edit it, we'll put it up there. So if you need to refer to these, there are 15 that are up now, anywhere from 2 minutes to 1 hour, depending on the topic. And so if you want to commit to this and you really want to stay focused on this, okay, because there's a lot of chatter, there's a lot of noise that's going to come to you in all directions from other sources. I recommend you to stay completely focused to this, okay, because again, I was talking to someone earlier on, we really have a 40-year window. Okay? All of us start out in life at about 25, and we've really got up till age 65 to get this together, okay? But by the time we get started, I mean, most of us get out of school, 25, and we're just sort of getting our feet wet, and 10 years have gone by. Got into a career, got into a business, started a family, and we're already in our mid-30s, right? And then, before you know it, and some people get displaced from one continent to another and whatnot. Another 10 years go by with all these adjustments. Your half-time is already over. You follow? And so there's, once you stumble on something that is, that makes sense, stick to it, okay? Because really you don't have the luxury of that much time before, you already get there. So a good tool is the YouTube channel, right? Go back, review stuff there at the, so it's youtube.com/the GPS process. Today's core financial insight. Stock market investing. Okay, so we're coming to this now. Again, this is now like I said, we're going into more technical stuff. Okay, so what I'm doing here is basically just scratching the surface. The attempt here today is for those of you who want to do stock market investing, versus what you're doing now, versus what the masses are doing right now, is buying funds. Okay, mutual funds. And there's a reason for that, because when you buy a mutual fund, the way that it is sold is you've got professional management. That's a guy who manages it full time, okay, professionally, and usually he's a chartered financial analyst. And you've got diversification, pools of money where they can buy. Okay, and that makes a lot of sense, except that the results are not there. Okay, and so that's what the downside is, and so that's to get around that. Okay, we're attempting to do this. All we're trying to do is buy wonderful companies. We're buying stocks directly, okay, at attractive prices. So what we're here to do is to determine what is a wonderful company and what's an attractive price. All right. Now, before I do that, I want to give you a disclaimer. Okay, all I'm doing here is reviewing the rule number 1 strategy that's in this book. Phil Town came up with this book in 2006, and all I'm doing is reviewing what's in here. Okay, so this is the text, right? The strategy is called rule number 1 strategy, and everything that I'm saying to you here comes from here. All I'm doing is just reviewing this. I'm not giving you advice to buy any particular stock. There's no stock advice being given here. And the caution that I want to also emphasize is that you are not to do this until you've completed steps 1 to 8. Okay, you have to get rid of the debts, build the emergency funds, make sure you're insured before you get into these investments. Okay, and even then, not more than 25% from the war chest. Right, the war chest is where we build securely, 3.25%, and if you're going to go out into the deep waters, no more than 25%. All right. Okay. Before we get into that, there was one session. We do 5 sessions on investments, and the first session was called Building Blocks, where I wanted to make sure that we're all on the same page. We're all from different walks of life here, and different different levels of knowledge when it comes to finances. So there are some basic terminology, basic terms and concepts that I want to make sure that we all understand. And we did that in the first session, which I entitled The Building Blocks. Okay, so I'm just briefly going to review them. The first one is that when I use the word capital, all I'm saying is the money that you invested. That's capital. Okay? Money invested, right? Second one is we're gonna talk about risks. Okay? The only risk that there are many kinds of risks. Okay? There are whole professions set up for people called risk managers. Okay? There are courses set up on risk management. But the only risk that we are concerned with here is one, okay, of losing our money. Okay? That's the only question we got. Can I lose my money? It doesn't get more basic than that, right? The other concept that we want to be concerned with is the return on investment. Okay? Basically, what am I earning on my money? If I'm going to take any risk, what do I get for my money? Okay, and that's how we assess it. Okay? Be aware, it's called the ROI. The other one is, there's two rules that you got to be aware of. First one is rule number 1, and the other one is the rule of 72. So let me just go review those with you. Rule number 1 of investing is what? Never lose money. And where does it come from? It comes from the best investor in the world, Warren Buffett. Okay? There are about 1,700 billionaires in the world, 400 in the US. Okay? But there's only one who made his money through investing. Everybody else made their money through business. Remember I was telling you that the fastest way to make money is in business? Okay? The other 1,699 people, billionaires in the world, all of them made their money through their successful businesses. Okay? The price of their shares went up like crazy. Warren Buffett is the only one who became a billionaire through stock picking. Okay? And he says, rule number 1 of investing is never lose your money. Guess what he said rule number 2 is? Don't forget rule number 1. Okay? So we don't want to get, no pie in the sky here. First things first, can I lose my money? If I can't lose my money, why should I bother? I'm earning 3.25% there. Why should I take it out from there? Right? 1 step forward, 2 steps backwards, which is what people are. They don't even ask that question. Okay? But you want to ask that question always. Rule number 1, can I lose my money? If I can, all kinds of alarm bells should be going off. Right? Rule of 72 is the other thing that you need to know, basic tools that you need to have. Just a review, if you may or may not know this. The rule of 72 says this, that if you take the number 70, it's a rule of thumb, okay? It's very accurate for interest rates, ROIs below 20%. As you go to ROIs above 20%, it gets less accurate, okay? So the rule says this, that if you take the number 72, you divide it by any return on investment, the earnings on investment that you're getting, the answer that you get is the doubling period. Okay, so let me give an example. If somebody comes along and says to you, you can earn 10%, this is a great investment advisor comes here, you ask him, what's the return on investment? He says 10%. You're sitting there and you say, look, I've got $50,000, you are asking me to invest with you. If I did, at 10%, 72 divided by 10 is 7.2. It's going to take 7.2 years for my money at 50% to grow to 100,000, to double. Okay, doubling period. So if he says you're only going to earn 3%, 72 divided by 3 is what? 24 years. Okay. If I'm only earning 3%, 3.25%, remember we had 3.25%, it's going to take 24 years. Okay. I mean, if I'm already 80 years old, I don't have 24 years. I need to make my money grow faster, right? But it gives you a sense of how, doubling period. And you're going to see how we're going to use this when we try to figure out the stock picking, okay? You can use that in the reverse too. You can also, if you knew what the doubling period is, you can figure out what the ROI is. If somebody gives you an investment opportunity and say you're going to double your money in 6 years, okay? Immediately, without that person telling you, you can figure out what the average rate of return is. If my money is going to double in 6 years, 72 divided by 6 is 12. What I'm getting is 12% per year. Okay? If that's acceptable to you, go for it. But if that's not acceptable to you, no. No, I want more, I want less. But at least you have got a tool now, quick tool to make that call. All right? The other thing that you need to bear repeating and review is I make a distinction between savings, investments, and speculation. Okay? When you're saving, know that you're saving. When you're investing, know that you're investing. And when you are speculating, know that you're speculating. Don't be speculating and thinking that you're investing or thinking that you're saving. And this is what the masses are doing. Okay? Ask them, do you have investments? Yes. Where are your investments? In mutual funds. That's not an investment. That's a speculation. I'll explain why I call that a speculation. Okay? Savings to me, and this is how I define them. Savings is where your capital is guaranteed and your returns are guaranteed. When you go and open a savings account at the bank and you deposit your savings there, the FDIC, Federal Deposit Insurance Corporation, per account guarantees your account up to $100,000. Okay? So you can deposit up to $100,000 in a savings account, and if that institution goes insolvent, right, your capital is guaranteed. And typical in a savings account, there's no risk involved. They're not taking the money and putting it, they're guaranteeing you 1/3 of 1% on a variable rate. And if you choose a term deposit, 1 year, 6 months, or whatever, for that duration, they guarantee you a return. Okay? So that's the one. To me, an investment is where the capital is guaranteed, but the returns are not guaranteed. All right? An example would be what? Segregated funds. Okay? I'm not talking about mutual funds. We'll come to mutual funds in a second. Okay? A segregated fund is a fund, a basket of stocks through a life insurance company, okay? And they give you a guarantee on the capital. They're the only ones who do this, okay? Because when the life insurance companies wanted to go into the fund business, the regulators told them you can do it, but just to make their life complicated, they asked them to put in guarantees, and they agreed to do it. Okay? So when you invest in funds, in segregated funds through life insurance companies, the capital is guaranteed, but the returns are not guaranteed. You're still subject to market fluctuations. All right? But you will never lose. So if you get 100% deposit guarantee, wherever the market goes, you're guaranteed. Now, I looked like a hero during the global financial crisis because I've never sold mutual funds for this reason. Okay? Along my journey, when the time came to get licensed for mutual, I didn't want to because there was no need for it. There's a lot of hassle and whatnot. So I just stuck with the segregated funds. And during the global financial crisis, right, when people lost anywhere from 25 to 45% of their portfolios. When a client called me, and I had only a few people call me, and where are my investments? With everything that I'm hearing, how is my investments doing? Okay, I say to them, yes, market value, it's gone down, but you've got this protection. Your deposits are guaranteed. Okay, you haven't lost any money. Okay, yes, and if it comes back up, but if you want to cash out today, you'll get back all of your money. You follow? And that makes you look very good because the last thing you want to tell someone is, it's down to 25%, down to 45%. It's their life savings. All right? So in investments, capital is guaranteed, but returns are not guaranteed. The next one is speculation, where the capital is not guaranteed and the returns are not guaranteed. Okay? So when you are, are you saving? Are you investing? Or are you speculating? Okay, just ask the question: is the capital and the returns guaranteed? If neither of those two are guaranteed, you're speculating. Is it okay to speculate? Sometimes it is necessary to speculate. Okay, so let me bring back that illustration here. What we're doing here in the savings. Sure the battery is good, but anyways, in the savings portion here, right there, the capital is guaranteed and the returns are guaranteed. You see where I've put in bold guaranteed? The returns are guaranteed and the capital are guaranteed. Okay, so this is a savings account, right? Sorry, both of these. This one here and this one, these are savings account. Why they are savings account? Because the capital is guaranteed and the returns are guaranteed. Okay? These three areas that we're going into, if we need to go into, stock market, real estate, and business, what are they? Are they investments? Are they savings? Or are they Speculation. Anybody? Speculation. They're all speculations, okay? Because the returns are not guaranteed and the capital is not guaranteed. This is why what we're going to do, knowing that, okay, we're going to build fences, we're going to minimize the risk. Okay? Wherever possible, we want to get the tax element, the tax component out. Okay? So this is why in the stock market account, we make that a TFSA account, so that we don't have to deal with taxes. It's a tax-free savings account. When you open your online brokerage account, when you get there, make sure that it's a TFSA account, right? So any gains that you make in there are completely tax-free. You don't have to deal with the taxes, right? Now in these two, we are not able to do that, okay? And hence, we deal with pre-tax numbers here, okay? So despite the fact that these are speculations, we go in there, but we try to minimize the risk, okay, and enhance the tax efficiency as best as we can, okay, and put a cap as to how much we put in there. And the only reason we do that, coming back to the rule of 72, is because of the return on investments, right? Because if I make 3.25%, it's going to take me 24 years for my money to grow. If I make 15%, it's going to take 5 years. It's a big difference between 24 years and 5 years, okay, for money to double. All right? Okay. Now with that, let's come to the rule number one strategy. So what is this rule number one strategy? So going back to what Warren Buffett said, whenever people ask Warren Buffett, how is it that you're so successful? He's a very folksy kind of guy. Now he's like, I think he's 83 years old now, right? Whenever you ask him, it's a very folksy kind of guy from Omaha, Nebraska. He said, I just buy wonderful companies at attractive prices. Somebody took that, okay, and tried to, put some substance to it. So we're trying to buy, with the rule number one strategy, wonderful companies at attractive prices. So what is wonderful and what is attractive? It's determined by 4 M's. In his book, the rule number one strategy, he says there are 4 M's that you need to look for. Okay, so this is what we're going to be. The first 3 M's will determine what a wonderful company is. Okay, and the last M will determine what an attractive price is. So let's go through that very briefly. The 4 M's. What makes a wonderful company? The first M is meaning. Okay, what he's saying is, Warren Buffett, Bill Gates was a board member on still is a board member on Warren Buffett's holding company, Berkshire Hathaway. And the way they got to know each other is because they are involved in a lot of charities and whatnot. And they both kept appearing on, as almost celebrity in financial circles because they are, number 1, number 2, number 3 in the Forbes list, right? So they got to know each other and they clicked. There was a lot of chemistry. Warren Buffett asked Bill Gates, because of his keen and sharp mind, to sit on his board because he wanted him on his board, right? But this 25 years of this relationship that they have, Warren Buffett has never bought a Microsoft share. You know why? Because I don't understand that business. Okay? He says, I understand Gillette, because he said, if you figure 7 billion people on the world, 3.5 billion are men, you got to get up in the morning and shave. It's never going to go out of style. They still have to shave, right? Because I do not know if Microsoft is going to be in business down the road. Okay? So he never bought Microsoft shares. And I was watching a video clip recently. He was talking to a group of business students. And he's saying, I made a lot of mistakes. He says, people look at my successes, but they never ask me because I know the mistakes that I made and the opportunities that I lost. Okay? But he never bought Microsoft because he doesn't understand it. So the first thing here is, the first M is, that business that you want to invest in must have meaning to you and will determine how you find meaning in a business. Okay? Second one is, there's got to be a moat. And I'll explain what a moat is. Third one is, we're going to look at the management of that company. Okay? The leadership of that company, because it's important. And how do we determine an attractive price? By something called the margin of safety, which we'll get into. All right? So let's go through them one by one. First, the meaning. How do you find a business that has meaning to you? First question you need to ask is, all of us spend money. Where do you spend your money? I love Apple products. And I just think that they are the best thing since sliced bread. I mean, you know, no one competes with them. They're so far ahead of the game, and you know, I don't know if you've seen this ad on TV. You can tell straight away that I'm a gadget guy. I love gadgets. On TV, there's this ad, iPhone ad, and I'm sitting there. They disturb you all the time. You know, like make you feel like you don't. You need to get the, you know, you're missing something, right? I'm sitting there watching TV, and iPhone ad comes up. I've got an iPhone 4, right? So this is iPhone 5. So the guy takes his camera, and there's a bunch of kids, I think about 25 kids. Hey? So he hits a button, and like an airplane comes up. So he tells all the kids, say cheese, and he's going around the room, right? And then he hits another button, it goes into his camera roll. And then the next scene is he's printed it out, big panoramic picture of these 25 kids, and he puts it up on the wall. I mean, it's an iPhone, and he's taking a panoramic picture like this. Like, it's crazy, but this is why I like them, you know. I have a client who is 92 years old, and recently she became hospital bound, and I told her, look, you know, reading was a problem, so I got her an iPod Shuffle, and I put there's a ministry called Faith by Hearing, and if you go on their website, you can download the ESV version of the Old and the New Testament, all the books of the Bible, in dramatized form, okay? So when they read the Bible, the guy says, you know, in Genesis, the serpent, and then he goes, and did God really say you cannot eat? You know, like, it's in the old days we used to listen to radio like this. So I got her that, and this lady is 92 years old. She's never read the Bible from cover to cover before. So after I got her that, and you know, a week later I had to go back and see her. She said, I listened to it 3 days in a row, and she said the battery ran out in the middle of something very exciting. Apple for you. 92 years old, right? All she had to do was press a button, go back, forward, and she was listening, and she can't read, but she can listen, right? And they do that kind of stuff. So the first place is ask yourself where you spend your money, okay? Because where you spend your money is because there's a reason why you're spending them. I love Apple because they're incidentally one of the richest companies right now, okay? But do we really want to invest with them? We have to go through the other criteria. But here's the first criteria. Where do you spend your money? Okay? Ask yourself where you spend your money. Then you want to list the companies, the industries where you spend your money, okay? The second thing you want to do is ask yourself what you're good at. What are your you know, how do you make your living, okay? What is your area of expertise, okay? Is it IT? Is it education? You want to be looking at industries and companies in that area, because that's familiar to you. It's your lingo. You speak that, like my world is the financial world, okay? You know, but I don't know anything about health. You follow? And this is why I always turn to Suzanne, you know, for health issues, because she's more well-versed than I am, okay? Or doctors, people in the health profession, right? The third place that you want to look at is what is your passion? What are you passionate about? Okay? What drives you? You know, what energizes you? And you want to list companies, industries, you know, anything that comes familiar. And what you want to do is look for something that is common to all three, okay? If you find, you know, a company, an industry that is where you spend your money, that, you know, where you earn your money, that where you spend your recreation, that you are passionate about, in this area here, if they all intersect here, you want to shortlist these companies, okay? And what we're looking for is 5 to 10 companies, okay? So in my case, for instance, it could be Apple, it could be, you know, Warren Buffett's, because I'm in the financial world, this is, you know, what I live, dream, and breathe, right? So to me, Apple could be one company that I'll be looking at. Berkshire Hathaway could be another one. Warren Buffett's company could be another one. And what you want to do is, based on these, you want to shortlist about 5 to 10 companies that you want to identify, okay? That you want to put on your radar, all right? So this is what has meaning for you, okay? Outside of this, you know, you're not sure. And this is how Warren Buffett, he never invested in Microsoft because he said, I don't understand that world, all right? Okay, the second M is to have a moat. A moat is just a deep, wide trench around a castle. If you've seen medieval castles, right, you have water around them, okay? and you have this bridge that comes up and down. When the castle owners, the occupants of the castle want to go into the bridge comes down, they go over, and as soon as they're over, the bridge comes up. Now everybody else is out. And in some modes, okay, they put crocodiles in there. If you want to try to get across, that's you get past the crocodile. So they took that concept and said, we want to look for businesses with an economic moat around them. Okay? They're so far ahead of the game, okay? Because if you have a good idea, sooner or later, you're going to have competitors. Okay? People are going to take that idea and run with it and try to, muscle you out. Okay? The problem is, if you are invested in a company and somebody else is at their heels and they muscle them out, it's your investment that's going down. Okay? So you want to be invested in companies with such a wide moat that it's very difficult to catch up with them. Okay? And this is why we need to be very careful here. So some of the things that that will tell you that a company has got a good moat are things like this. When there's a brand, okay, they've got a brand name. Example would be Coke. 200 countries. In the most remote part of the world, if you look at their distribution system, it's crazy. Okay? The thing passes all, from bottling plant, and then you get this guy in these muddy places with a wheelbarrow. He's taking his Coke to go and sell to his constituents, right? But in 200 countries, okay, been around for over 100 years. Okay, Gillette, McDonald's, or they might have a secret, a patent, okay, which if you're going to get legally challenged. If I'm in the IT world and I wanted to encroach on Intel's patents, I better have a pile of money to fight lawsuits first. I think twice before I do it. Okay, so there's a moat there. There could be a toll, monopoly, utility companies, Nova Scotia Power. Yeah, they are, water is a big deal now. Okay, water companies in many parts of the world, Halifax Water is saying, we need to raise your rates because all the pipes around Halifax are more than 100 years old because we need to improve the pipes. Okay, many governments don't have the money to improve the infrastructure. Private companies are coming in, so let us take over. Okay, and there are downsides to that because in some places they've raised the cost of water where it's not even affordable, okay, because of this. Okay? But we're not looking from that. We're looking from as an investment. They have a monopoly. They can get away with it. When the guy from the Halifax Bridge Commission wanted to raise the prices, he said he needed the money. But if you look at their financial statements, they're running profits and surpluses. Okay? Because they have a monopoly, I want to use the bridge, I have to use it. I don't have a choice. Okay? Then you've got another indication that there is a moat is when switching is just too much of a hassle, too much of a headache. You're using Microsoft. Okay? I want to switch to Mac. Okay? You know what I'm saying? And people like me, I did switch to Mac anyways because I love Apple. But when I did, I still had to use the PC world because the world that I function in the insurance world, they are still PC based. So despite the fact that I've gone to Mac, I have to go back to PC to do stuff from my suppliers, right? Switching is difficult, okay? Price, okay, Walmart, Target, Home Depot, all these companies, if you are a mom and pop operation, there's no way you can compete with them, okay? They'll just squeeze you out, okay? Because of the volumes that they have, they can come down on the price. But from an investment point of view, okay, as long as they've got such a wide moat that no one can encroach on them, it indicates. Talking about technology, RIM, Canadian company RIM, okay, see how dangerous it is. RIM, when Obama came into power, and one of the first countries he visited was Canada, and Peter Mansbridge had a one-to-one with him, right? And at the end of that conversation, Peter Mansbridge said to him, by the way, you're walking around with a piece of Canada. And I'm sitting there, and I'd already got to move to the iPhone by then, because I used to be BlackBerry too. And I'm sitting there, I'm saying, that's funny. Here's the American president who's got a BlackBerry on his, which Peter Mansbridge brought attention to. And here I am, a Canadian, I've got an iPhone, an American. And the reason for that, it was difficult. He's a government guy, you see, and very difficult for big. RIM catered to the business community, but even then, okay, their stock price, because of Google and because of iPhone, right, went down from a high of, I believe, $150 to 90% of that about a few months ago. Okay. So if you had invested in that, you see your wealth, 90% of your wealth going out of the window. Reason you want to be careful here. All right. So these are the how you get a sense that a particular company has got a wide moat. Okay, some indicators, but a more concrete way to tell if a company has got a high moat, a big moat, is to look at 5 numbers, 5 economic indicators. Okay, now for some of you who are seeing this for the very first time, if you have no financial savvy, I'm just going to gloss over it. Okay, but all I'm going to do here is stir interest. Okay, if there is any interest, if you decide someday you want to go further, okay, get hold of the book, read it 1, 2, 3, 4, 5 times. There's a lot of material available. Get in touch with me. We'll hash it more. But I just wanted to tantalize you, basically, that this exists, that this is a way of doing it. Okay, and if you have the time, the inclination, the energy, the desire to do this, we'll go much further. Okay, so these are the numbers. These are the economic indicators that you're looking at. Where can you get these numbers? From the company itself. Today we are very privileged because of the online world. Okay, everything you can get online. You can get it directly from the companies, from their websites. Okay, if they are public companies, they'll give you all of this. You can get them from big sites like MSN Money, Yahoo Finance. Okay, they'll put this out, where they want to bring in traffic. And then you also have commercial sites like Zacks, Z-A-C-K-S, Zacks, where you pay them a fee and they clean it up for you and give you more detailed information. All right, they do that for a living. But whatever it is, these numbers are available, and these are the numbers that you're looking at. The first one is return on invested capital. Second one is the growth rate of sales. The third one is the growth rate of the earnings per share. And I'll briefly explain these. Okay. The fourth one is the growth rate of equity. And the last one is the growth rate of the free cash flow. If all of these 5 numbers, you go and research them from the company, from commercial websites or from public websites, MSN Money, Yahoo. You just go look for these numbers of that 5 to 10 companies that you shortlisted. Okay? If the average over the last 10 years is 10% or more, then you're moving to the next step. If it is less, don't bother. It does not have a moat. Okay? It's it doesn't have a wide enough moat. It's not worth it. There's thousands of companies out there. You keep looking until you find one. Yeah, because you will find it, right? Now, very briefly, return on investment capital. Coming back to my illustration of that kid who opened a lemonade stand, parents gave them $200. They went out there, and they made $300. Okay, the return on invested capital. What did they invest? They invested $200. What did they make? $300. The return was $100. The return on invested capital was $100. Okay, so here, the first thing you want to look at in a company is, did you make money with the money that you put in the business, whether your own money or borrowed money? If you didn't make money, I don't want to be part of your problem. You know what I'm saying? But if you're making money, yeah, we want to. We want to be a part of that business, right? So first question is return on investment. How much are you doing? And that number you can easily get from any company. Okay? If they're not making money, back off. Let them clean up their act first before you consider them. Okay? Just strike them off your list. Second one is growth rate of sales. Well, that's quite easy too, because sales of a company is the lifeblood. Okay? Any business, the money coming in is the sales, however you want to call it. Okay? That number has to be growing by 10% at least every year. If it's not, why bother? Sure, it's very difficult. Believe me, it's very difficult. Okay? To make your company, but hey, it's my money. I'm looking for a place to invest, right? So I am in a position to choose. If you don't have it, I am sorry, right? But there are companies who have that, okay? Whose sales are growing by more than 10, and their full-time job is to go get more market share. They know that if they don't, somebody else will squeeze them out, okay? So we are going with the people who are still standing, all right? Growth of sales, growth of earnings per share. Now, coming back again, I want to keep the illustration simple so that everyone can understand this. Coming back to my illustration, and that illustration, by the way, is in the book. Okay, and it's a great book because he uses simple illustrations to teach this. If we take that kid who took $200 and he went out there, made Then he tells his parents, look, you know, I like this so much, I want to do this every summer. Okay? So the parents say, oh, now you're getting serious. So, you know, let's buy some equity here. So what the kid does is he says, okay, let's form a company. Okay? He incorporates a company and he issues 2,000 shares, right? And he sells 1,000 shares to the parents. Okay? He keeps 1,000 shares. Now, if in that scenario, before he did that, if he earned $100, right, and he has 1,000 shares before he got his parents in, he only had 1,000 shares, earnings per share is 10 cents. $1, he made $100, 1,000 shares. Was it $1? $1, okay, whatever the number is, right? You take the earnings, divide by the number of shares, you get earnings per share. What you want to do is go and get the earnings per share numbers over 10 years and then find out what the average is. Okay? It has to be 10%. If it's less than 10%, pass. Not interested. Okay? The next one is growth in the equity. Same illustration. The kid has this and he's been doing it a couple of years. And let's say at the end of 5 years, you know, he's got laminate material for $1,000. He's got cash in the bank for $2,000, and he decides, I want to go to high school, I want to go to university, close the business, right? So sell everything, sell the lemonade stand, sell all the materials, and you know, take the cash, and all he ends up with is $10,000. And then now there's two owners. There's him and his parents, so they got to split it half and half. That is called the equity. Okay, the equity. When if you liquidate the business, what is left is called the equity. Okay, you sell everything, and what's left? We want to see that equity growth rate every year. Is it growing? How? And that's a very critical number. Okay? Because if a business's equity is not growing, then why would I want to invest in that business? They're just bringing money in and putting money out, and they're just surviving, right? Finally, we want to look at the free cash flow. Again, you know, after the money comes in, they pay out all the expenses. The money that is left, how much of it is cash? Okay, the equity, because equity could be, you know, stuck in brick and mortar and whatnot. I want to see how much cash there is. This is the cash that can come to me. Okay, free cash flow. All right. So without getting too complicated, all of these numbers, like I said, are readily available if you want to look for them. You want to look for 10 years numbers, and depending on which direction you go, you can get them for you all worked out. You can, you know, if you want to be like me, just go to public sites, gather the numbers, and then work out the averages. You can do that too. Okay, but if you want to pay a fee, there are sites that will give you these numbers at a touch of a button. The 10-year average, the 5-year average. Okay. Now the third M is first thing is that, you know, that company that you're looking for, that you shortlisted, has to have meaning for you in terms of your money, where you spend, in terms of your talents, in terms of your passion. Second thing is it's got to have a moat. Okay, it's got to be a leader in its field, so far out that, you know, it's very difficult for anybody to topple them. Okay, at least there are indicators of that, and also there are numbers that substantiate that. Okay, it's not just a feeling that you have like, oh, they're so far ahead. No, no one knew that RIM, okay, with the lead that it had, okay, with the business community, was going to come to the state that it's in now. How would you tell it? And this is how you tell it, okay, through the numbers, 10 years numbers. You know, we're going to look 10 years out by looking 10 years back. All right. The third thing that you want to be looking at, and these are all ways to minimize the risk, okay, is to look at the management, okay, the people who are running the company, the CEO. Are they driven? Okay, do they run this company as though they own the company, or, you know, do they have a big audacious goal? Example would be Steve Jobs, right? Steve Jobs had this big audacious goal that he wanted to marry technology with the arts. Okay, you know, he's saying that aesthetic beauty and arts, you know, that world, he wanted to mix it with technology. He doesn't, you know, he wanted, and this is why you get, my grandson was here recently, and his mom put out her iPhone, and 2 years old, right? He could find the game and he could play with it. Intuitive, you know, show them once, and he could find his way around. My 92-year-old client friend, I'm suggesting that she get an iPod. Her whole family is against it. They say that she won't be able to handle it. I disagree. I think that, you know, you get to know it, you'll find your way. 2-year-olds can find their way around. I mean, you will not know 99% of it, but you know enough for your own purposes, right? So make sure that, the leaders, okay, are not just people who are just feeding at the trough. Okay? Some public companies, what happens is these guys come in, they've got a 4-year mandate, okay, and they've got stock options built in. They've got, no skin in the game, They're making a huge salary, and, if at the end of 4 years, if the stock value goes up, they'll just cash in their stock options, okay? But there are other businesses. Warren Buffett, for instance, in his company, when he started Berkshire Hathaway in 1965, he gave himself a salary of $100,000. Guess what his salary is in 2012? $100,000. Okay? Because he said, why should I take my money out? It's earning 23% there. I can't do better outside, so I'll just leave it in there. So this takes what he needs to live on. Okay? So the ownership of the owners. Warren Buffett wanted to invest in a Chinese company in China. One of his directors or somebody on his staff brought his attention, because he's very patriotic. He invests only in American companies for the longest time. Started investing outside of USA now. And one of the first places he invested was in China, in an electric car company. This is several years ago. And one of his, I think, financial officers brought it to his attention that he should look at this. And he did. And when he did, he wanted to buy, he looks at all of these numbers, he crunches the numbers, and made up his mind, I'm going to buy that company. I think it's going places, right? And so he wanted to buy 25% of that company, and he's got the money to do this. The owner said, you're not getting more than 10%. He said, as soon as he said that, I decided even more that I want this company more badly. You know why? Because the guy's got skin in the game. He doesn't want to give up ownership. He's got everything in that company. You follow? So you want to look for things like, these are very soft things. You got to read, you got to listen, sort of read between the lines, who's there just for the short term, who's there, and just feel it out, okay? And if you see that, this particular company that has got a good CEO, been there a long time, with a big audacious goal, it all looks good, okay? Part of all the ingredients that we're looking for. So when you got these 3 ingredients, you've got the makings of the makings of a wonderful company, okay? So coming back to this, okay? Savings, where the capital is guaranteed. So we are speculating here, and because we are speculating, we need to do this, okay? Because our capital is not, when we invest in the stock market, our capital is not guaranteed, and our returns are not guaranteed. So we have to do everything to minimize that risk. And by doing this 3 things, by making sure that it has meaning for you, by making sure that the company has a moat, either because of those obvious indicators, or the economic indicators, the 5 economic indicators, okay? And if there's very solid management, okay, because the guy is driven, he's owner-oriented, right? Or if he's got a big audacious goal, these are great indicators that we can minimize the risk, that we're taking here. All right. All right. The 4th one. Once you've identified a wonderful company, the next thing you need to do is make sure that you're paying an attractive price for it. Okay. And the way that it's done in the rule number 1 strategy is, we go back to the rule of 72, okay? Remember in my previous slide, when we invest in the stock market here, what are we shooting for here? 15%. The only reason we do it is because we want to get 15% on our money versus 3.25% in the war chest, okay? So if that's what I want, if the desired ROI is 15%, then using the rule of 72, right, the doubling period is 4.8 years. 72 divided by 15 is 4.8. So roughly, 5 years, okay, approximately 5 years. So what we want to do, in essence, like in a nutshell, what what he's saying here is, if I want to get 15%, and I use the rule of 72, the doubling period is 5 years, okay? And, we want to buy, we are projecting 10 years out, okay? We want to make sure that when the sticker price, and I'll come to sticker price in a second, is 25% of what the market price is, that's when I want to buy, okay? Right? Actually one half of 25%, one half of the sticker price. Okay, let me put some meat to that. Okay, when you have anything of value, there are always two prices. That's the market price, okay, and the price that you can get it for, the bargain price. What we're looking for is not bargain price, what the actual value is. So let me give you an example here. Royal Bank of Canada has got how many branches? At least about 1,000 branches across the country? I don't know, but let's say 1,000 branches, yeah? And in these branches, you've got people working, you've got, you know, equipment, they've got assets on their balance sheet, okay? But yet, let's say Royal Bank has 20 million shares out there on the public market, right? From one day to the next, let's say today, Royal Bank share is listed at $50 per share on the market, okay? And then you get up Monday morning and you go to a website and put down Royal Bank's symbol, and you see the price has gone down to $40, from $45 to $40, okay, in the market. But has anything changed over the weekend as far as Royal Bank is concerned? The real Royal Bank, like, what has changed? Nothing has changed. You follow what I'm saying? They still have whatever money they have in the bank. They still have the assets that they have. What has changed over the weekend is the supply and demand, okay? This touchy-feely, you know, that's going on in the, you know, people buying and selling. You follow? When there's a demand for something, the price goes up. When there's no demand for something, the price goes down. If people are selling, the price goes down. So you have a whole bunch of people out there, financial investment guys, who are sitting there doing, you know, being very analytical and decide to sell or to buy or whatever. What they do is affecting us. So what Warren Buffett said is, the reason why I'm a good stock picker, he said, is all I do is I watch out for the mispricing of the market. Okay? So what I do is I look at a company and I try to understand what its intrinsic value is, what its real value is. Okay? Because its real value is not what's being reflected in the market. The market is really based on buy and sell. Okay? Supply and demand, buy and sell. Market, the prices go up. But that is not a real reflection of what the value of this company is, the real value of this company, which is called the intrinsic value, which we are going to call the sticker price. Okay? What's the sticker price? If we can figure out the sticker price, okay, and then we sense that the market has mispriced it, we want to buy it when we know that, you know, if I know that the market, if Royal Bank shares are selling at $10, okay, and I use all this and figure out that, you know, the sticker price of Royal Bank really should be 40, okay, and it's really one, you know, when it should be 80 out there. This is $10 when it should be 40 out there. You know what I'm saying? Let me put it properly here. I valued the sticker price, and I know it to be 40. It works out to $40, right? But out there, it's only 10. You understand? So I know that, look, if they price it properly, they have to price it at 40. But if they're giving it to me for 10, I'll take it. And I'll just wait until they bring it back up to 40. Because sooner or later, it's got to come back because this is the real value. You follow what I'm saying? I'll give you another example. I told you I like Apple, didn't I? So I went on Kijiji, and I bought this iPod Nano. If you go to the Apple store at Halifax Shopping Center, they're selling them for $129, right? So I got there, and it's $129. I don't want to pay $129. So I go on Kijiji, and this guy who says he wants to sell his, because they all want to upgrade, right? Like I told you, sit there and they'll disturb you, make you feel that you don't have the best. So I got disturbed too, but I'm a bit smarter. So I go to Kijiji, and I find this for $50. He wanted 65, I think, and I bargained it down to 50. Okay? So now I have an iPod. So it's used, so it's 2 years old. But so what? I mean, I know Apple. See, where the meaning comes, their products are good. Okay? They make good stuff. They last a long time. They can't go wrong. But this is what I'm saying. Okay? If this is, the value is $129, right? The market price is $129. I only paid $50. I can go and sell on Kijiji now maybe for a bit more. Do you get a sense of what I'm saying, what we're trying to do here? All of these companies, public companies that are out there, there's a market value that is based on emotion, that's based on the pressure to buy and sell. Okay? That dictates the market price. What we're trying to do here is figure out what the intrinsic value is, the sticker price is. And if you can figure out the sticker price, you want to buy it when it's a fraction of what the, right? So this is what it is. So how do you figure out did I pass? Okay. Okay, so the trick then is to determine the sticker. So buy when the sticker price is 25% of the market price. All right? So that's the essence of it. So how do you figure the sticker price? Again, some of these terms, like if you are not familiar with them, it's going to take some doing, okay? You've got to do some legwork to become familiar, especially if you haven't done any finances whatsoever. They're quite technical. But when you get there, you need to sort of really get immersed, okay? So I'll just briefly go through them. The way that you figure out the sticker price is you take the current earnings per share. So come back to that illustration where we talked about the kid with the lemonade stand. So he's issued 2,000 shares, 1,000 to himself and 1,000 to his parents, okay? So that's 2,000 shares out there. If at the end of the year, they make $2,000 after a few years in business, now they've got 2,000 shares, earnings per share is 2,000 divided by 2,000 shares is $1 per share. That's the earning per share. So what they say is you take the earnings per share at the estimate, multiplied by the estimated growth rate for 10 years to obtain the future earning per share. Now, if you once you've, through your meaning and through your mode and through, after identifying the management, you've got a short list of companies. Then you go to that company and you just look up the earnings per share, the current earnings per share, okay? And then you find out what either you calculate it yourself or you get hold of the earnings per share growth rate. So if my earnings per share is this, and I either work it out or buy or take it off a website, the earnings growth rate of that earnings per share growth rate, if I'll multiply the current earnings per share by the earnings per share growth rate, okay, for the next 10 years, it'll give me an idea of what the future earnings per share is going to be. Now, if I take that in the second step, and if I multiply that by, again, another new term I'm putting up here, what they call price earnings ratio. Okay? Again, these are numbers you can get directly from the companies, okay, without being a financial guy. Just go there. What's your price earning ratio? You multiply the EPS by, you're going to get the future market price, okay? And then when you divide the future market price by 4, you're going to get the sticker price and the margin of safety. And this is, again, we come back to that illustration where we say if we're going to go out into the deep waters, okay, we want to take as many precautions as possible so that we don't sink, right? And so the margin of safety price is 1/2 of the sticker price after you figured it out. So basically, let me just see if I can put it in another way that would make more sense. What we're trying to do here is when we invest, okay, we are trying to invest to make at least 15% of money. So we are trying to sort of trick most people when they invest, if you ask most people, do you have investments? Yes. What's your return of investment? I don't know. I try to get as much as I can get, but that's not good enough, okay? Because then you might end up with nothing and losing everything, right? So what we want to do is we want to say, look, I'm making 3.25% guaranteed on my money. If I'm going to move my money out, okay, there's got to be a reason. I want at least 15%, right? So then I use the rule of 72 and I say, okay, if I'm making 15% on my money, 72 divided by 15, my money will double every 5 years, okay? So if I have $1 right now, if it doubles every 5 years, $1 5 years from now will double to $2. 10 years from now, the $2 will become $4. You follow? So use the idea of $1, it'll sort of run this idea of 25% for you. So if I have $1 and I'm shooting for 15%, there's got to be 2 doubling periods because 72 divided by 15 is 4.85, okay? So if I have $1, 5 years from now it's going to be $2. 5 years then, okay, the $2 is going to become $4. Okay, so if I have $1 and if I hope to make 15% over the next 10 years, at the end of 10 years it's got to become $4. Okay, so right now while I'm sitting here, I need to know that the future price is going to be $4. Okay, you follow? So this is what this exercise is. When you go through this exercise, what you're doing is you're taking the earnings per share, you're multiplying it by the future, the earnings per share growth rate to project the future earnings per share. Okay, and when you do the third step, when you multiply the future earnings per share by you get the future price, and then you're dividing it by 4 to come back to today's price. Okay. And then, as an extra precaution, okay, although you already figured out that this price is going to be 4 times in 10 years, you're saying I'll only buy it if it's half of that price. I'm not paying $129, $50. Okay, so this is how you prevent yourself from losing it all. It's complicated, I know, when you're seeing it for the first time. Like I said, it's not for everybody. For most people, 3.25%, I don't have to worry about interest rates, I don't have to worry about where the stock market is going, is fine, okay? Plus there's an insurance element to it. But if you have the time, the inclination, and the energy, if you go through this, if you do this, your time commitment is about 15 minutes a week. Okay? Once you've done all the legwork, okay, and you've got 5 to 10 companies on your radar, okay, you're looking for all of these numbers, all you're doing is watching the numbers and think about, do it like once a week, you have to check the numbers. When everything pans out, because it's all set up, okay, you're going to pull the trigger, basically, buy the share, and then just wait for it to earn you 15% and monitor it, okay? So I don't know how much sank or how much, where you're at, okay, but understand that the purpose of this is just to make you aware that this exists, and if you want to take it further, we can go further, okay? Because, like I said, most of us will stop here. We won't go beyond this, right? But if you do want to go into this, it is available. This other one that we're going to do next session will take about 3 to 5 hours a month, okay? Because some legwork to be done there too. You got to look out for those properties. There's some, research you have to do to make sure that it fits your criteria. But then again, it's worth it, because if if all we're looking for is 1, 2, because it's dependent on how much money you have here, and even then we are putting the cap on how much money you're going to play with this. So there are constraints, okay? The amount of money, but the time is only about 3 to 4 hours. This one is more involved, okay? And again, this is not for everybody. All right? Now, with that, I'll take any questions with respect to first the GPS process that we talked about in the first half, or on the stock market investing. Anybody? Any questions on anything? Going once, going twice. It might be a bit overwhelming depending on what space you're in, okay, but I'm here to create awareness. Okay, create awareness that this exists. If it is your cup of tea, let's develop this. You can start by getting the book and start reading it. I think you should read it a couple of times. Some of the illustrations are very simple, but it'll make you more financial savvy. Be aware of this. All right? If there are no questions, I want to thank you for taking the time to be here. I know you had choices with your time. Saturday morning, it was cold. But you chose to be here, so I commend you. Okay, these sessions, I am totally convinced. I've never been more at peace with myself and more confident with what I'm doing than now and at this stage of the game. Okay, and I need your help, because I need to be able to get this message out to as many people as possible. So if you have found value in what I'm doing here, help me. Okay. Over the next 90 days, you're going to brush shoulders with a lot of people, particularly this 90 days, friends and relatives and whatnot. And, be aware of people's troubles. And many people have financial troubles. They're very proud. They will not say it. But be aware, and if you sense that, you know, they could benefit from this, pull them along, okay? Tell them about this. Bring them, okay? And, you know, you'll be helping them. Because if they become empowered financially, you know, things will improve for them, okay? So have a wonderful next 90 days, and I will see you in January. Suzanne just reminded me there is a feedback and survey form that is on your desk. Do fill it up before you leave. Now, I just want to bring your attention to the, also to the cash envelope and the budget sheet that is there. Very important, okay? Don't want to put you in a straitjacket, but get used to the idea of a budget, okay? Cash budget and also a monthly budget. Don't be rigid about it. Just put numbers. All you want to do is get a sense of where the money is coming, where the money is going, and if things get out of whack, out of hand, at least you know it, okay? Most people have their heads buried in the sand, hoping that, you know, as long as the money is there, everything gets paid and everything will work out. It may not, okay? There's a better way of doing it. Get used to it. It's like everything else. It's difficult at first, but once you get, you know, you make it a habit, it's, you can't do without it. All right? Okay, so fill up the budget, fill up the worksheets and the feedback and survey, and I'll see you in 90 days. God bless you.